Hello and welcome to SwitzerTV Property. I'm Peter Switzer. Well, doubts still abound about the outlook for property. But if the stock market can be trusted, and it can't be 100%, and you look at the recent run of our economic data, you could be forgiven for being relatively optimistic about the property sector. This week we've seen the 10% contraction of the economy forecast that was out there, right out there by many of the experts. It's been pulled down to 8% by the head of Treasury, Dr. Steve Kennedy. But then the OECD came out and reckons Australia will contract in 2020 by only 5%. Now, if all this is true, that should be good for unemployment, and that should therefore be good for property prices. So with all of that on board, we caught up with the Chief Economist at REA, Nerida Conisbee, to see what her crystal ball, which taps into the biggest database of real estate buyers, sellers and browsers in the country, to see what she's actually seeing there. We later talked to Martin Kennedy from Compass, whose report shows that there's a shocking gap between the income of renters and what's needed to avoid housing stress. And our coal-faced property business this week is Trilogy Funds Australia. And we talked to its MD, Phil Ryan. How worried is he about the property market right now? So let's kick off with REA's Chief Economist, Nerida Conisbee. Well, the predictions were that house prices would really collapse in the worst case scenario with the coronavirus crash. But so far, the news hasn't been all that bad. So let's catch up to see what Nerida Conisbee, who is the Chief Economist at REA Group, is seeing right now, but also in her crystal ball. Thanks for joining us, Nerida.
Thanks for having me.
Great
topic.
Yeah, great to see you. So your recent market update says you've yet to see a clear indication of a recovery. So what are you actually seeing in the data?
It's been really interesting. I mean, obviously we are now tracking data very, very closely week to week. We did see in the first 2 weeks of the lockdown, there was a dramatic drop in activity. And at that stage, it was quite alarming. You know, we're not only seeing a drop in searches, but we're also seeing a drop in listings as well. But pretty much since the third stimulus package has been announced, we have seen a very big pickup in search. So, you know, search is one thing. We know that a lot of people were on our site just kicking around. They've got a bit more time, perhaps just having a look. But we are also seeing higher levels of engagement. We're also seeing higher levels of inquiry as well. So inquiry is really important for us because it obviously shows that people are on the site and they're looking, but they're actually also quite motivated to contact an agent. So for now, it does look like established housing is the sector of the market that is holding up a lot better. For the new development, that's probably the most challenged. Home builder has helped a lot. We've seen a very big spike in inquiry levels pretty much since that announcement was made. But longer term, a lack of investors is an issue at the moment. A lack of foreign investors as well is also a problem. So really that off-the-plan sector will be the one that will take the longest to recover.
I've never asked you this, but maybe inside the deep crevices of your wonderful economist brain, you've probably looked at the data that you're referring to then, and whether you've done this officially or you've done it just inherently, it seems to me that the data you're talking about would be the basis of a home buyer confidence guide. Have you guys ever done that, or have you just basically, in a sense, looked at the level of interest and all that sort of stuff to work out whether home buyers are getting more confident and therefore they're looking more?
Well, it is good that you mentioned that because this week we did just release a demand index where we did go more into detail around engagement on the site. We do know, I mean, one of the problems with our data, we do know that, campaigns can really lift activity. We know that greater market dominance we are the number one portal. We get greater market share that can obviously lead to greater levels of search. So we have been working really, really hard. So Cameron Kusher, who works with me, he released a report this week. So it's actually on our site in our insights section. So, definitely worth a look, because it does show, pretty consistently that on one hand, we've seen search drop and then we've seen it dramatically pick up. But then when we look more deeply into what's happening, we can really clearly see that buyers are very active, they're very engaged. They're moving beyond just searching around and moving to being, far more likely to buy than they were, definitely were at the end of March.
What is your best guess of what's going to happen in let's stick to houses and apartments to be bought for owner-occupiers as opposed to investors? We'll finish off on the investor market because it is trouble because of Airbnb implications and whatever. But what is your feeling about what we might see in the September and then the December quarter, which of course houses one of the best periods for selling and buying homes?
Yeah, look, I do think if you are looking to find a bargain for an established home in a well-regarded suburb or a suburb with high levels of amenity. So, typically when we talk about high levels of amenity, we look at the sort of factors that people seem to be more interested in. So, that's typically things like shopping centres, a really good shopping centre, really good public transport, really good schools. So, houses in those areas do seem to be holding steady in terms of what we're seeing with activity. I think that will flow through to pricing. I don't think it will be possible to see a bargain for a house in Paddington in Sydney, for example, or a house in South Yarra, or even a house in somewhere like Watsonia in out of Melbourne. I just don't think there's going to be quite the bargains that people are expecting. Apartments is different. If you have a look at, maybe, we can talk about investors, but, there is quite a different dynamic occurring with apartments, and a lot of it has to do with the problems we're seeing around investor activity and overseas investor activity, but also even supply. When we were going into COVID-19 lockdown, we were seeing very, very good conditions in the housing market, and particularly the premium housing market, but we hadn't really started to see a significant recovery in the apartment market in high development areas.
So I guess I'm trying to pin you down on probably two questions. One is, from what you're seeing now, are you expecting a serious price fall or basically price stability ahead of maybe a pickup later in 2020 or early 2021?
Yeah, it's established housing and is what I would expect to see, pretty stable conditions. It will depend where you are. What we're seeing in somewhere like Canberra is off the charts at the moment in terms of activity. I think Canberra pricing will hold up a lot better potentially. Perth is another one. Perth was starting to recover going into COVID-19, but it does look like it is doing quite well on a lot of the metrics we look at. Hobart, which has been a favourite of mine for quite some time, I think will be hit harder, primarily because it is a market that is very reliant on tourism. It's very reliant on foreign students, and pretty much all of the economic growth that that state has seen, or the positive benefits of economic growth have come from those sectors. So, I think a market like Hobart may struggle more, but somewhere like Sydney and Melbourne, we will see greater stability. I think though, one of the problems I have with people, the way people look at data is that they do tend to look at the headline level, and on one hand, established houses in great suburbs, they're doing fine now, and they'll probably keep doing fine. But there is a marked difference across suburbs, and there's definitely a marked difference across property type.
So let's talk apartments for investors, and a number of the contributors to this program over the last few weeks said Airbnb has been a bit of a problem. Why don't you talk us through what you're seeing there?
Yeah, the Airbnb, that happened immediately. I mean, we were tracking furnished listings weekly, pretty much from mid-March. And so we did see a huge spike in the number of furnished listings coming onto the site. I do think, but then from there, we have seen a reduction in the number of furnished listings. So, I think what we're seeing now is that we'll gradually return to normal. We are starting to see tourism pick up again. We're starting to be able to move around a lot easier. An issue, obviously, is foreign tourism, but then on the other hand, we spend more overseas travelling than we spend, than foreign tourists spend here. So, hopefully that will kind of balance out. But, Airbnb listings don't seem to be as big a problem as they were. Even the rental market seems to have stabilised a lot. I mean, one of the things we did see is this big pickup in Airbnb listing or furnished listings coming up on the site post-COVID lockdowns. But the really big impact was a big increase in just rental listings in general. So I think it was partly the Airbnb, but it was also people just moving back home with family. There was foreign students not returning. There was just a whole. We saw a pickup on our flatmates site at that time. So, there was just a whole lot of dynamics that were leading to this situation in the rental market where, on one hand, we had renters who were highly exposed to, the COVID lockdowns very, very early on. And then we also had this pickup in rental listings. So it was, quite a negative situation, particularly for investors, which I think is why many of them are very, very nervous at the moment about diving back into the market.
Okay, so to wrap up, Nerida, for all those people out there who were stressed out, worrying that there would be a serious drop in house prices because of the coronavirus, or on the other hand, people were hoping there were so they could buy a place at a good price, what are you saying about that big dramatic fall in house prices?
Yeah, it's not playing out, on any measure that we're seeing. We're just not seeing it, and ultimately it will depend on what happens with unemployment. But now we are getting back to work, and things are looking more positive. So, I guess in summary, it certainly wasn't the fallout that was predicted early on. I think there were some people, predicting 30-40%. But even, we may even come out of it with higher house prices in some locations.
It's going to catch up to you, with you, and I always say, I hope you're right, not wrong. And that was Nerida Conisbee from REA, and we now catch up with Martin Kennedy from Compass to understand how much stress renters are under right now. Well, joining me on the show is Martin Kennedy from Compass Housing, and Compass is a business that looks at things like mortgage stress, and at the moment there's apparently a bit of a crisis going on in this particular area. Martin, thanks for joining us.
Pleasure.
How long have you guys been checking out mortgage stress?
We tend to focus on rental stress mainly for people in the private rental market. It's something we've been looking at for about 3 years now.
Okay, so your survey then is more about renters feeling the stress, or have you looked at mortgages as well?
No, the Affordable Housing Income Gap report that we put out a week or two back was focusing purely on rental stress, specifically for people in the private rental market.
Okay, so tell us, was the rental stress there before the coronavirus? And if so, what were the prime causes of the stress?
Yeah, look, the interesting thing was that what we found is that housing stress or rental stress, it's not just something that affects low income earners, which is how it often gets thought of, I think. Even people on median incomes can struggle to find suitable rental properties that don't absorb more than 30% of their household income, which is normally what we use as the benchmark for rental stress. And, in a lot of places, typical renting households are sort of tens of thousands of dollars per year short of the sort of income that they'd need to avoid housing stress on a medium price dwelling.
So try to talk us through how someone ends up being in rental stress and still have a pretty good income, because you're implying there's not just the battlers out there income-wise, there are middle to upper middle income people who are finding it stressful. What is
absolutely.
what is the profile of that sort of person?
What we're talking about is people in well, the private rental market in general. People tend to have slightly, below, or the median income of people in the private rental market is slightly below the sort of the overall median, I guess. But we are still talking about people who are on what we would normally think of as, a pretty average income. And it sounds a bit strange to say if we're talking about what's driving this situation, given we're talking about the private rental market. But the results are really a product of two things. The first of which is that the supply of social housing is too low. And the second of which is that purchase prices are very, very high. And the result of that is that you end up with sort of people flowing into the rental market at both ends. And they're two distinct groups of people who probably wouldn't have been there 30 or even 20 years ago. The first group are obviously people who in previous generations would have been homeowners. But these days, even as you had falling interest rates that have kept repayments sort of vaguely manageable, you've ended up with this deposit gap, which has meant that anyone who doesn't have access to the bank of mum and dad has a pretty difficult time accessing or getting a foot in the door. So there's that group. And then the second group obviously is people who in previous generations would have been in social housing. These might be more low income working families, but these days social housing is pretty much out of the question for that group because there's such demand for it that it gets rationed and people in that category can no longer access it. So you get both of these groups in the private rental market.
Has the supply of social housing on a per head basis reduced substantially over the last 2 or 3 decades?
It definitely hasn't kept pace with population growth. And I mean, the evidence for that is that you see these sort of significant increase in waiting lists over that period to the point where there's now sort of in the order of 150,000 households Australia-wide on waiting lists for social housing. And the scary thing is that probably only captures a small fraction of the true level of need. I did a piece of work a year or so back trying to get a sense of the true level of need and sort of concluded that based on the current criteria, eligibility criteria around the country, the proportion of people who would meet the current criteria, who are eligible for social housing but not living in it, is probably about close to a quarter of all renters in Australia.
Yeah, it's quite staggering. Is the problem made worse because not only is the supply of social housing coming from government instrumentalities a problem, but also the population increase via immigration is quite substantial? And I would have figured a lot of the immigrants end up with a higher priority to get into social housing. Is that a correct assumption?
Look, not necessarily. It depends on people's citizenship and residency status. So people who are temporary migrants, for example, would generally not be eligible for social housing. People that have been granted citizenship or have permanent residency, for example, through the refugee program, for example, would be eligible. But there's no sort of prioritising people based on their immigration status, I guess. It's done purely on the level of need.
What about the, are there disincentives for developers to actually, rise to the occasion and start producing social housing?
Yeah, I mean, definitely, because what you're talking about is a product that is by definition rented out at below market rates. So someone has to make up that difference. That tends to require a government subsidy to make the thing equally attractive to what people could get in just developing housing for the private market.
Is there any state government that is leading the way and showing the other state governments what needs to be done in this space?
Yeah, look, there's definitely some that are doing better than others. I mean, unfortunately, pretty much across the board, none of the states have got a plan to sort of deliver the volume of housing required to meet their waiting lists. But there are definitely some that are doing more than others, and probably the New South Wales government at this point in time is probably leading the way. They've got an initiative called the Future Directions for Social Housing Policy, which has got some pretty innovative stuff in it. So yeah, they're probably leading the way at the moment. So.
Look, I know I've often done some stories around the actual costs on actually developing sites for lower priced land and package type products, And it's been made clear to me that a developer could be up for about 1/3 of the overall cost in paying for government taxes, fees and charges. Is that a fairly significant obstacle to actually getting lower priced housing, which then also might come with lower relatable rents?
Look, I'm not a developer, and it's not my area of expertise. So, look, I'm sort of reluctant to speak with any great certainty on this. But given that new supply sort of comprises a fairly small portion of total property transactions in a year, sure, I suspect that fees and charges and things like that probably do have an impact, but I suspect they're not the main impact in terms of property prices.
One trend that I've picked up over the last few weeks talking to people in the industry is that there's a lot more investment properties on the market because Airbnb suppliers of properties don't have the same customer base because of reductions in tourism and whatever. Could that be a helpful situation to overall reduce rents and then reduce the severity of the current crisis?
Yeah, look, it's going to be interesting. I think now that we're in this sort of strange new world where population growth is going to be a lot, lower than it was, or borders are, completely shut at the moment, and with unemployment trending higher and things like that, you would have to expect that rents are probably, at least in the short term, going to be lower than they were previously. How far they fall and how long they stay down, I guess, is going to be driven largely by the economic recovery and how long the borders remain shut. But I guess the other thing to keep in mind is that falling rents, that's going to be a good thing ostensibly for renters. But you can only derive the benefits of those lower rents if you've managed to sustain your level of income during that period, which is no sure thing for a lot of people in the current environment.
If the Treasurer came to you, Martin, and said, well, you're an expert on this problem, what would you suggest I do? What would be the main initiatives that could take away the current severity of the stress that renters are facing?
Wow. I mean, look, it's a huge issue, and obviously, like most things, there isn't a silver bullet. I often talk about housing policy missing the middle in the sense that most of the interventions tend to be about either supporting first home buyers or providing crisis accommodation for people whose lives have gone very seriously off the rails. But good housing policy needs to be about more than just sort of scooping up the people who've fallen through the cracks. We really need to be looking at how we can fill in the cracks to stop people falling through, if I can put it like that. So, putting first things first, we need to get serious about providing the social housing for that section of the community that needs it. And the estimates vary, but we are talking about hundreds of thousands of homes here. And the benefit of that is that it actually creates a pipeline of work that wasn't there previously, which is not necessarily the case in other forms of housing stimulus, which can end up sort of subsidising projects that would have happened anyway. So there's social housing, and then at the other end of the market, and I'm aware that this isn't a very popular view in certain quarters, but property prices do need to be allowed to adjust lower. And I mean, in terms, that adjustment can happen in nominal terms or it can happen in real terms and take a heck of a lot longer. And I think realistically, if we're waiting for wage growth to make housing affordable again, we're going to be waiting a very, very long time. So really the only way this gets fixed is lower prices. And that's going to be difficult for a lot of people. And I say this as a property owner. I mean, I'm not sort of thrilled about the idea of losing some equity in my home either, but I'm not really thrilled about the idea of living in a world where no one can afford to retire either. That's sort of the road that we're heading down. So I think the way that our market works at the moment sort of risks sucking the wind out of a lot of the rest of the economy, and it really sort of undermines the viability of the retirement system. So, higher property prices are not necessarily an unvarnished economic good.
Maybe I should get you to write a story in terms of what advice you give the Treasurer to fix up our rental problem.
Sure.
I'll hold you to that, Martin. That's Martin
No problem.
Kennedy from Compass Housing. Thanks for joining us. That was Martin Kennedy from Compass. And next up is Phil Ryan from Trilogy Funds Australia. And let's just see how he's seeing the property market right now. Well, each week we'd like to talk to someone at the coalface in the property sector to see how things are going, particularly with the coronavirus and all the challenges that it's thrown at all businesses. It's very interesting to see what the Managing Director of Trilogy Funds, Philip Ryan, has to say. Phil, thanks for joining us.
Hi Peter, how are you?
Good, mate. So for people who don't really know what Trilogy Funds actually do, just in a nutshell, explain it.
Yeah, sure. We look after a variety of property and mortgage trusts that we operate, which have exposure to areas such as commercial, industrial real estate, and also residential real estate.
Okay, so effectively you pull money together and you provide it for people who are actually out there building commercial properties, residential or whatever. Is that basically the business model?
Well, the areas are a little distinct. In relation to commercial property, what we have is standalone property trusts, and they purchase property on behalf of investors on the eastern seaboard of Australia. So typically they would have ASX listed or major national tenants as an anchor tenant, and then they would have other tenants around that. Our industrial property trust, you're quite correct, is a pooled property trust. So in relation to that, we actually purchase industrial property, and that is in areas from Queensland down to South Australia, predominantly in regional and near CBD major town areas. As for our pooled mortgage fund, that actually provides development and construction funding to property developers, again on the east coast of Australia. In relation to that, we actually do pool investors' money to provide the rates of return.
And if people go to your website, they'll get a good idea of exactly what you guys do.
That's right.
Tell me how you felt when you saw the implication of the coronavirus and the whole idea that governments are going to close down economies.
Yeah, well, look, the interesting thing there, Peter, is that it was government induced. It's not like the case of a normal recession where, there was over exuberance or anything in the economy which indicated that interest rates would go up. If we all remember back to 1991 days, etc. In this case, government induced, and it almost happened overnight. Paradoxically, for us, the major issue we suffered was actually in capital markets. So we have another fund called Trilogy Enhanced Cash, which invests investors' cash in cash and cash-style investments, such as government bonds and also investment-grade bonds as well. Now, ordinarily, with interest rates coming down through the COVID-19 restrictions, right? Ordinarily, Peter, you would have expected with interest rates coming down that those cash and cash-style investments would have done well. But with the COVID-19 restrictions and closures, etc., that caused a dislocation in the capital markets, which meant that those type of assets didn't provide the rates of return that we'd normally expect. And as a result of that, our rate of return in the Trilogy Enhanced Cash during that period of time from March through to now has actually suffered a decline. And of course, when you look at the rates of return from the Trilogy Monthly Income Trust, it's mainly been driven by the income produced by the mortgage assets rather than the cash component of the fund. So that was very much a surprise to us because they're the safest sort of capital stable assets that you would ordinarily have out there, but they are the ones which actually cause the most grief. I've got to say, since then, we've seen that capital markets have stabilised, and even today we look at the Westpac report in terms of consumer confidence, etc. It's now back to pre-COVID levels, and we expect that that confidence will flow through the rest of the economy gradually.
Okay, you've talked about the Westpac consumer confidence number, and of course the ANZ Roy Morgan's gone up 9 or 10 weeks in a row. All good signs that
Nasdaq's at a record high. Who would believe?
Yeah. So it's kind of like it's great to see the consumers back and business confidence good yesterday. what are you seeing? What are the critical indicators for you to make you think that your business is getting back, or getting back to normal is going to be hard because you've gone through a tough time, but what are the key indicators that you are seeing now that makes you feel either confident or still a bit apprehensive?
Well, in terms of the mortgage trust, there's two sides of it. One is the supply, and again, remember back to recession era, you would have seen, going back to the 1991 days, there was typically a lot of builder failure. We were concerned that we might see supply issues flowing through to developments in relation to being able to attain goods from overseas. We really haven't seen that across any of our sites. We've got over 85 loans in the Trilogy Monthly Income Trust, spread from Brisbane, Sydney, Melbourne, and we just haven't seen that. The other side of the equation is in terms of demand, and we were obviously concerned that we'd see a drop in sales by reported through from borrowers. Interestingly, I think the investor market is soft and will continue to be soft. There's a couple of reasons for that. One is, of course, we've all seen that the Airbnb style investor is now putting their property now more long term, so they're competing with other long-term investor landlords, and we expect that market will soften compared to the uptake by the first home buyer. And if you look at the first home buyer, they've got support now by the federal government and also through the state government. So in Queensland, for example, you can have a first home buyer who will receive up to $40,000 as a grant, either from the state government and also the federal government, towards a new home. So we saw during that COVID crisis still good solid inquiry from first home buyers, but I think that will start to improve now. But obviously, until tourism is sorted out, we'll see investor demand continue to be fairly soft. Now, if you look at our commercial style properties, they're still performing well. Again, we haven't had. We thought we might have demand for rental relief from various tenants. We haven't seen a lot of that. We actually had quality tenant inquiry during the COVID crisis as well.
Okay, so in terms of, there must have been times when you must have been worried about your business during the closures and the lockdowns phase. What is the situation of your business right now?
Business is good. We've got a solid loan book in terms of the mortgage investment trust. We've got still plenty of inquiry coming through from loans. In terms of the commercial property, that's performing well. We're actually looking at industrial properties to acquire now for the industrial portion of our of the industrial property trust.
All right, Phil. So basically, you're feeling that the worst is behind you, and you're expecting some kind of rebound in business between now and the end of the year?
Yes, Peter, we are. I really think that things are still quiet. Particularly, we're now in the CBD. We've come back in after mid-May, and it's still very quiet in CBD. I thought that there would be more people here in the offices. I'm a bit concerned about larger corporations still operating from home.
Yeah.
In some respects, I've got to say, at Trilogy, we're actually very happy to be all in here because we find it a very much a collegiate sort of atmosphere. But so from that point of view, I think that big business won't be back in capital cities until, say, July through to September. And I think from September on, we'll start to see a recovery. Obviously, there are concerns out there. I think long-term concerns around retail, but we have very little to no exposure to retail-style assets. I don't know how shopping centre owners, for example, are going to deal with their portfolios, given that they've got so many closures. And even walking around the Brisbane CBD, we're still seeing quite a lot of vacancy, which I haven't seen personally, probably since about the 80s and 90s.
Yeah. Well, Phil, thanks for joining us and good luck going forward.
Thanks, Peter. Thank you. Bye-bye.
Thanks for joining us on SwitzerTV Property. And if you have any issue that you'd like us to cover, send us an email to info@switzer.com.au. I'm Peter Switzer. Thanks for joining us. See you next week.